In this episode, we'll explore the institutional liquidity traps and help you become a more mindful trader. Be sure to watch this video carefully until the end and keep your notepad ready, as we're about to share some valuable insights. So traders, if that's something you're looking for, kindly give this video a thumbs up to show your support and subscribe to our channel. We'll catch you right after the intro and disclaimer. Before moving on to the liquidity patterns and liquidity scenarios that often appear in the market, let's start with a basic introduction to smart money and liquidity, and clarify the exact definitions of these terms. Imagine that large financial institutions, commonly called smart money, want to buy a currency pair. To do this, they need a considerable number of sellers and corresponding sell orders in the market. This is necessary because without sellers present, no trades can take place. Therefore, smart money must trigger the stop-loss orders already positioned in the market to carry out their buy or sell orders. It is frequently suggested that smart money may manipulate the market, creating conditions that mislead traders into thinking they fully understand price movement. This produces an illusion for retail traders, making them believe they are positioned on the correct side of the market. Yet, in reality, the market heads toward their stop-loss levels and, after taking them out, resumes its natural trend. To survive and grow as a consistently profitable trader, it is vital to spot liquidity on the chart. These zones, where large clusters of orders exist, can reveal market behavior and help avoid major losses. Liquidity is divided into two main categories: static liquidity and dynamic liquidity. Let's briefly go over each of them. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the forces that drive market price action. To understand this better, picture a market structure such as a rally wave that consists of a high and a low. These highs and lows indicate external liquidity. Essentially, external liquidity relates to the highs and lows within a rally wave. Meanwhile, the fair value gaps located within the range of the high and low are considered internal liquidity. Market price is always shifting between internal and external liquidity. You can think of it as a continuous cycle where price moves either from internal to external liquidity or from external back to internal liquidity. If we examine the schematic diagram, it illustrates a rally wave moving upward, sweeping the external liquidity accumulated above the previous high. After this occurs, price transitions toward internal liquidity, represented by the fair value gap, in order to fill the imbalances left behind. From there, price shifts back toward external liquidity, sweeping above this high. Once the external liquidity is taken out, price then seeks balance by targeting internal liquidity again. This leads the market to drop and fill the most recent fair value gaps. Now, let's move forward to the details of static liquidity. Static liquidity refers to the specific zones in the market where large pools of capital are positioned, such as stop losses or pending buy and sell orders. When a trader is stopped out of a position, the market absorbs the funds tied to that stop loss. Identifying a liquidity sweep pattern before price reaches our point of interest is essential. This pattern confirms the strength of our supply or demand zone, and we use the liquidity sweep as a confirmation tool. The idea is simple: the market requires liquidity to generate momentum. If price does not sweep liquidity before reaching a key level, it often uses that zone itself as liquidity to fuel the move. Static liquidity can be spotted in different regions of the chart, such as below equal lows and above equal highs, above swing highs and beneath swing lows, below or above dynamic trend lines and channels, inside order blocks, around support and resistance levels, and within Fibonacci retracement zones. Having a strong understanding of static liquidity zones highlights their major influence on price direction. Ignoring them can result in heavy losses. Many of these zones and patterns are particularly important since they are commonly recognized by traders, drawing in more stop losses and pending orders, which increases the likelihood of price moving toward them to capture liquidity. Now, let's turn our attention to practical liquidity patterns and scenarios that are more likely to drive price action compared to other liquidity areas. Spotting these zones on our charts increases the reliability of our strategies and improves the probability of successful trades. The first practical liquidity pattern we should consistently look for in the market is defined by equal lows and equal highs. As the term suggests, When price creates internal lows at the same level, we identify it as an equal low. Similarly, when price forms internal highs at the same level, it is recognized as an equal high. Equal lows and equal highs fall into two separate categories: the double bottom or double top, and the triple bottom or triple top patterns. Now, let's examine the specifics of each pattern and understand the psychology behind their formation in the market. Imagine a structure like this. Price makes a bullish break of structure, pushes upward, and then retraces without reaching the demand zone formed by the boss wave. Instead, it establishes an internal low. It then attempts another push upward, but the bullish momentum is not strong enough to break the most recent major high. As a result, price pulls back again, failing to break the internal low, which leads to the creation of a double bottom. During this stage, many retail traders who rely on chart patterns enter long positions after identifying the double bottom. They also set their stop-loss orders just below the equal lows, creating a significant pool of liquidity. Consequently, price rallies upward, fueled by the buying pressure of these retail traders who went long. However, as you may know, smart money frequently manipulates the market, designing scenarios that mislead traders into believing they understand price action, only to trap them and trigger stop losses, creating further momentum. To better understand how this market manipulation works, let's draw a bullish trend line by connecting the recent lows. Many retail traders who use trend lines interpret the bearish pullback as a breakout of the bullish trend line. They eagerly wait for price to retest, providing them with a selling entry, believing that bullish momentum has ended and the bulls have lost control. They enter short positions once price breaks below the trend line. As price retraces upward, they also place stop-loss orders just above the internal high. Notice how price briefly reacts to the trend line and produces a temporary bearish wave. This reaction attracts even more traders to enter short positions, with their stop losses clustered above the internal high. This sequence creates a perfect buy-side liquidity pool, waiting to be cleared by the market. Traders, I think this video is getting longer, which might feel overwhelming. So, let's cover the remaining topics in the next video, which will be uploaded tomorrow. Be sure to watch it for a clearer understanding. Stay tuned. That's it for now. Traders, thank you for watching. I hope you found this video helpful and insightful. Please give it a thumbs up, and don't forget to subscribe and enable notifications to stay updated with our latest content. Your support truly means a lot. See you in the next episode.